declining bond yields is improving the prospects for subnational and corporate issuers to come to the capital market. To get more on the outlook for Nigeria's bond markets, I'm joined in the studio by Femi Ademola. He's head of research at BGL. Femi, it's always a pleasure to have you on the show. First of all, maybe your thoughts on the fall in inflation rates. I think when you look at bond yields today, the expectation, of course, that is the important thing, inflation expectations when you're looking at bonds. Okay. Even though inflation is down to 9%, it suggests, if you're looking at the bond yields today, that many people are expecting that it's still going to stay below 10%. But your thoughts on the importance of the bond yields being at 9% for the broader capital market at this time?
Thank you very much, Wale. First, let's talk about the inflation rate. It fell to 9% in January 2013 from 12% in December 2012. While the fall is expected, I think the magnitude wasn't as much as expected. Now, we know definitely, when I say expected, is because we know that the base rate in 2012 was very high, and therefore, based on that base rate, the one we're going to have in January 2013 too will be very low, but not as low as this. Now, the implication for yield now is that having traded at negative real yield for some period of time, return, now, investor can make huge positive return on their investment in the bond market. So now the yield is attractive, even as low as it is, because it still gives them positive return, which is probably one of the best in the world now. So it attracts investors and makes investors want to come to the market as more as possible. And again, like you said, we expect that this inflation will be kept at single digit for the major part of this year. So what are your expectations for what this means for the capital market in terms of issuance? Maybe some corporate issuers may begin to look at the market going into the second quarter, you think? Yes, I think it's very positive for the capital market. One, issuers, like you said, because the rate is now low and it's tending going down. Like we said, expectation for inflation rate is that it's going to remain in single digits throughout the major part of the year, which means that yield can continue to go down as well, based on expectation. Now, the market has priced us into it, and a lot of people are coming into it. So at that low rate, one, government finances, it makes perfect sense. When government was raising bond at the marginal rate of 16%, 15% at the early part of 2012, now early part of 2013, they're raising it at 10%, maximum of 11%. So that's the perfect one for the government. So major gains for the government in terms of interest costs. Yeah, but even for the corporate issuer, subnational bond, a lot of them that have been in the pipeline, they can now come to the market. It provides alternative even for the corporate businesses to go to the market now and raise bond because they can't get from the bank anyway. So now they are looking very good, very attractive. But what's your sense? Even if we do get those issuers coming to the market, we know that yield curve is extended to 20 years now. That's right. But I'm not sure everyone is expecting a low inflation, or should I say, not everyone is comfortable that inflation is going to remain at very low levels over the next several years. But do you think that we could see issuers perhaps issue 10-year papers in your view, or do you think we'll be limited to the 5 years we've been seeing recently? To a large extent, I think we're going to be limited to that part, because even if you look at the yield curve, it is tending to be active only at the lower rate, not at the longer term rate, at the shorter term of the curve. The long end remain mostly as stable as it is. Yes, I mean, we've seen a little bit of moderation in those parts as well, but longer term, and we know the way Nigeria is, long term expectation is a little bit uncertain. We are still evolving. A lot of reforms that will sustain most of this expectation of inflation rate and lower yield is not yet there. We are just starting them. So I think it would not be advisable for anybody to even go too long term, except for government that we know is quite certain and secure to a large extent. But for corporate and even subnational, I think it makes sense for them to just stay at the shorter hand. Well, maximum of 5 and 7. Certainly good for the government to issue 20 years at the current yields. Yeah. But okay, let's talk a bit about how this is likely to impact lending, because there's been a lot of talk about the banks not lending enough. Now that we're seeing yields come lower, there's perhaps a little more pressure on the banks to begin to lend money to the real sector and even to other productive sectors of the economy. Yeah, my take is that, I mean, there's two-pronged attack on bank lending. I'm going to use that word. In the first instance, because the yield is collapsing, what that means is that the opportunity to make substantial return from just security trading is closing for the banks as well. Right. And for them to sustain the kind of profitability they have in 2012, they have to do something else, which I expect will be financial intermediation. They have to increase the creation of risk asset. Again, the capital market, as we expect that the yield is going to keep this low in this period of time, offer another alternative to businessmen that have been keying up the gate of banks asking for facilities. Now, since the alternative is there for them to go to the capital market to raise bond, it might be very cheaper than what banks give to them. It forces the bank again to react. So my expectation is that going forward this year, 2013, we are going to see a lot more financial intermediation.
So a lot more activity on the corporate side. What about the subnational side, though?
Subnational fund as well, yes.
I
think
the state governments.
The state government bond, exactly. I think there must be some quite good activities as well, because already there are some have been in the pipeline that have been waiting for the right time to come out. Sure. We have River State that has been on the pipeline. We have Delta Bond that's supposed to do a second tranche. Kogi is going to raise bonds soon. Oyo State is in pipeline as well. I mean, even Abia, Akwa Ibom, they're all waiting for the right time to come, and they have been waiting in the wings. I think this present great opportunity for those guys to come. And we need it, because again, sure, if care is not taken, there might bob in the market. So we need to expand opportunity for instruments so that investors that are coming will see things to buy and not just the same.
Okay, so it's always very difficult to call this, but where do you see bond yields going?
Well, like I said, because of our expectation for inflation rate that is going to remain a single unit, I think the yield will remain very low. I mean, to this, it's going to go down further. Because like I said,
you think?
Yes, it's going to go below 5%, because as I said earlier,
by
even
when, since second quarter, you think?
Yeah, I even in my explanation, remember that again, there's expectation of the listing of Nigerian government bond in the Barclays bond that's going to happen in March. So until after that, that's when we're going to see a projection of where bond might go up. However, because of one of the indicators and objective of the MPC, the CBN, is to make sure that they provide positive return for investors, there may be some action from the MPC, but I don't expect to see that in 2013. Well, I think the market has moved on from that.
Certainly be watching MPC, I think, with bated breath this time. I think this is one MPC that a lot of people are anticipating that we may just see some tweaking to monetary policy, but of course, up to now, they've been quite conservative. Yeah. But wait and see. Thank you so much. Femi Ademola is head of research at BGL, giving us his thoughts on the Nigerian fixed income market.